All right. We're live. All right,
Yep.
let me share it real quick. Hi, everyone. Well, so let's give us a few minutes to set up our webinar. All right.
Yeah, more people are joining. That's
Yeah.
great. Good to see you guys.
Yep. Tell us where you're from in the chat box below. All right.
Let's see how many states we have.
Yeah. We should have like a map of the U.S. and put pins on it.
Yeah, that would be cool.
Yeah, we'll be starting another minute.
Mhm.
Let's give a few minutes for everyone to join. Try to. Okay. Also try to figure out Facebook.
Mhm.
I'm putting this on the Coast to Coast meetup webpage as well. Let me see if I
Yep.
can put that on there.
You probably want to tell people about Coast to Coast and where they can find this Facebook page, maybe.
Yeah, that is a great topic. While we are still waiting for a few people to join, I think this is going to be a good time to talk a little bit about the Coast to Coast Facebook meetup page. Well, I mean, the Coast to Coast was a dedicated group to share and learning about multifamily and commercial real estate investing. So the group here, well, we're located across the U.S. From Seattle, New York, San Jose, San Francisco, Los Angeles. I probably missed a few, Tampa, and I think we just expanded to all four corners of the U.S. and Texas, right? So 5 corners. So tonight, I mean, we have, I think, probably a heavier than usual from the East Coast participation. That's great. So again, let's see where people are in the chat box. There he is. All right. So, well, before we begin, let me share a few events that will be hosted by Coast to Coast. So first, we have the co-investing series, where we underwrite a commercial deal together, and the group just we have a few data junkies here, so we share a lot of data on that webinar. It's, in my opinion, it's probably one of the more intense educational experience, and we analyze deals together. So it's kind of fun testing the assumptions and shooting holes at it. And then a second series that we also run is the news and webinar series. So we collect and distill the most relevant to us news and about the economy and real estate, and talk about how these large forces are at work and how they're shaping the investment landscape. So we plan to have a little bit different format in August. So we might do more of a networking event. So stay tuned for that. Also, by the way, you can learn more about our next event announcement at the Facebook Coast to Coast Meetup webpage. And also for our newer investors who just got the real estate bug, or anyone who wants to learn more about commercial real estate and how it works, we also are running the Real Estate Fundamentals series. We'll kick that off again in August. Also, well, tonight we have a new series called the Investing Ideas series, where we will cover advanced topic. Well, for this particular one, we'll be choosing the right asset class to invest. So to kick off the series, I invited our speaker, who's also a current Wall Street risk manager, analyst at a hedge fund, and one of the founding member here at Coast to Coast. So Yan Yan will be talking and share about asset allocations and comparisons. All right, so here's some of the high level housekeeping. We feel free to type in your questions in the Q&A box, or use the raise hand feature. And this presentation is being recorded, and you will automatically receive a copy by email at the end or at next day. Also, the information is, well, is shared only to members. And also, we're not selling any deals, so we don't have to worry about PP&A. This is a strictly educational uh, webinar only. With that, you might be familiar with some of our past attendees or panelists, some familiar faces as well. So if you would like to speak to any of us, you can see we'll have the contact information a little bit later at the end. And tonight, here is our panelist or our speaker. I'm really excited to have Yan Yan to be our speaker. Well, Yan, why don't you start by giving us an introduction about yourself?
Hi, everyone. My name is Yan. I work in New York City, live in New Jersey. Today, I am very happy to share with you guys my thoughts on investment, especially in current uncertain environments. So those are the thoughts on my mind. I want to share with you how I think of these questions. I don't want to give you a straight answer because everybody will have different answers due to their own situation. But hopefully at the end of this, we can give you a checklist. So when you go through your situation, you will have your own answer. So that's what I try to achieve at the end of this talk. And there are a lot of contents. We try to condense it in an hour. So some of them we might not delve into it, but we want to give you a high level introduction. So next time when you think about this, you will have a framework. So framework is what I want to present it to you guys.
Yeah, thanks. So, I mean, we do have a lot of content to cover tonight. I think it's important for the audience to know, how you become a commercial real estate investor. I know you have a Wall Street background, and I would thought you want to focus primarily on a lot of your energy in the equity and the bonds market. But can you kind of share with us kind of what do you do in your day-to-day job as a risk manager?
Right, sure. So my day-to-day job is I'm actually a risk manager for a quantitative hedge fund. So quantitative hedge fund, basically we use some statistical model, try to predict the market and then try to make money out of it. So I am a risk manager. I cover market risk. So for guys who are not familiar with term, so market risk basically tells you how much the value of your portfolio change day to day due to the market movement. So my job is to make sure that my firm does not blow up when you wake up. So those are the things that I do day to day.
Got it. Yeah, I hope you didn't have a heart attack back in March.
Yeah, I
Yes.
survived.
So I guess you're not I would say real estate royalty or insider, so to speak, right? You kind of brings in from a kind of outside from real estate perspective. But what kind of skill set do you see that you might be able to apply from your job as a Wall Street analyst to real estate?
I think you are absolutely right. So definitely compared to a lot of audience, actually invited a lot of real estate professionals to be here. Compared to them, I have much less experience. However, I think it could be a bad thing. It could also be a good thing. So look at the bright side is that, okay, because I don't have a lot of experience, right? So I look at it from a outsider perspective. I look at it with fresh eyes. And also I bring in a lot of skill set I learned from finance world and apply to real estate. Because to me, your capability of analyze data is the key capability. It doesn't matter whether the subject of your study is financial data or real estate. It applies to all of them. As long as you have the capability to process a lot of data, understanding the economy drivers behind those data, it should be good. So to be specific, I think the skill sets that's transferable to real estate world is, first thing, I think, the capability to process a lot of data and understanding the economy force behind it. Those are the two things. Third thing will be, okay, I look at real estate not as an individual or standalone as a class. I look at it from a portfolio perspective, meaning that I would not invest all my money into real estate or any of the asset class just because it might have highest return in the past several years. I look at it as a portfolio. So basically, I try to see how do I allocate my capital into different asset class so that as a portfolio, they achieve my investment goal, my goal of return and my desired risk level. So that's what's different from maybe the audience.
Yeah.
So look at it from portfolio perspective. Also, one last thing I want to mention is that I am a risk manager by trade. So when I look at it, I tend to first focus on what is the downside. Am I protected in the downside? If I'm protected, I feel very confident, right? So then I can look at the bright side. Okay, maybe if you look at the risk reward profile, you will have huge upside, but protected downside. That's the thing that we want to invest. So I would think these are the unique perspective that I can bring into this real estate world.
Yeah, that might actually be a bit unorthodox because a lot of syndicator or sponsors are trying to talk people to solely invest in one vehicle. A lot of them do not kind of diversify, at least not in the traditional real estate world, it sounded like. So it's definitely great to have a very different perspective. But also kind of, will you be kind of help share with us like what gets you started in real estate? Do you have maybe a personal story to share?
This is a good question. I actually have a very interesting story to share. So my real estate journey started 2 years ago. So before that, I am completely opposite of who I am today. So basically, I don't like real estate at all. I don't want to own a house. Although I have the capital, I never want to own a house because I think once I own a house, I get attached to it. And then every month I have to pay the mortgage and then I cannot move, right? So I feel like I lose the freedom. So that's why psychologically I don't like it. But what happened 2 years ago? So basically, actually it happened 5 years ago. So my previous company was an asset management company under a reinsurance company. So what they do is that, okay, reinsurance company as insurance company, they take a lot of premium, they invest, right? Instead of outsourcing to like a BlackRock to do the asset management, they decided to have investment like a professionals inside the company. So that's what we do. So because the reinsurance company is doing great, so someone wants to acquire us, which sounds like a good thing, but
Payday.
but as a risk manager, the first day when I heard the news, the first thing I do is that I go online, I change my resume, right? So then several months after that, I had a lot of interview and then I successfully landed myself to a very famous quantitative hedge fund, which I just passed the fifth year anniversary. So I want to say, okay, so after that, when I quit, my coworkers are very surprised. They said, "Why you quit?" They said they will leave our business intact, right? So nothing will change. You will just stay here. I said, "No, I don't think they will do that." And because I'm on my work visa, if there's anything changed to my job, I cannot stay in the United States. So that's why I need to make move. Okay, fast forward 2 years later, 80% of our team were laid off or whatever, right? So they just pay you and then you have to leave your job. And then I talked to my coworker after that. I said, okay, what's going on in your world? He said, I'm busy with my landlord business. I said, what's going on? You are a portfolio manager. Why you are fixing toilet for other people? He said, since they let me go, I realized that because he's already very, very senior, right? So he said, so when you climb up the corporate ladder, it becomes, you have higher and higher risk. If something happened to you, it's very hard to get a job with similar pay when you get older, right? Imagine you have 5 years to your retirement. So that's the wake-up call for him to have passive income. After talking to him, all of a sudden, it become this is my aha moment. I don't like house, from personal view, right? But this is an investment that can protect you from, for example, losing your job, right? So you have passive income. So yeah, so after that, basically I just learned a lot, like reading a lot of books, like Rich Dad, Poor Dad, talk about you don't want to be those kind of person like running on the treadmill, but once you stop running, you don't have income. Regardless how high your income is, you definitely want some passive income. So overnight, I switched my mindset from I hate real estate to I want to invest in this thing. So I learned as much as possible, and then I also in less than 2 months, I bought my first house, and then that's also when I was doing a lot of like a snowboarding trip. So that's how I show my determination, because once I decided, I just want to move forward. This is a long story, but I guess if you guys want to have some takeaway, I want to say, okay, always think about risk. Sometimes bad thing can happen, even it's a good thing, right? The company was purchased because it's doing good, but to me personally, it's a bad thing. So you need to always have a plan B, and also don't always rely on your income. You need to have passive income. And what is the vehicle for that passive income? You can decide. But to me, I think real estate is a good vehicle to generate passive income. So that's a long story. Yeah.
Amen. Amen. We could sit around on this snowboarding lift and talk about real estate next time. Yeah.
Yep.
Okay. So do you want to take over and present?
Sure.
If you can do a new share and the
Okay.
yeah, we can see a computer desktop right now.
Okay. Okay. So I might talk very, very fast because I try to control it under 1 hour. But if you're interested, just stop me and ask questions. Yeah. Okay. So I want to set the expectation right. So after this talk, what you will get is not a straight answer, what asset class I should invest in right now. Instead, I want to give you a framework. I want to give you a checklist. And then if you follow step by step, you will have your own answer because everybody has different situation. Okay, today's topic. First, I will have a very general, high-level discussion about asset allocation framework. We will talk about different aspects, return, risk, and then cash flow, liquidity, whatever. And then also, when we talk about different asset class, real estate is one of it. So how do I look at it? What's its return or risk compared to stock or bond or whatever? And then the third topic will be, okay, because the uncertainty in current environment, should I be invested? Is it safe to invest? If it is, what asset class in general I should invest? Or if we zoom into real estate, because real estate has different sector as well, which one historically speaking, it's more resistant to COVID or any type of crisis. And then maybe after reviewing all this historical data, we can do a little bit projection. What we see will emerge post-COVID. So the end goal, hopefully, is that you will have your own answer after this talk. All right, so a very brief introduction about asset allocation. So this is a very high level of how finance will think about investment. Sorry about the formula, but what I'm trying to say is that when we try to solve an equation, so basically we want to max out your utility. Your utility, simply put, is just your happiness or your satisfaction, right? So it's a function of your wealth, your happiness, your health, your freedom, whatever you can put into here, right? But at the same time, when you maximize this, a very key component is wealth, right? So your investment. But at the same time, you're also subject to some constraint. So you try to solve this subject to this constraint. So your investment goal is actually a function of your asset allocation. So that's what I mean by using asset allocation as a tool to achieve your goal. So now let's dive into it. So there are three components: goal, constraints, and then I will talk about the asset allocation part. So, when we review the goals, when you write it down, there are different type of goals, right? Different people will have different answers, right? So some people just want to grow their capital base as quickly as possible. Some people say, I want stable, predictable cash flow. Some people say, I have high pay job, so I want to reduce my tax, right? So different people have different goals. So, but when you try to pick the goals, you need to consider the following things. Sometimes there are conflicts between different goals. So let me give you a concrete example. This is an example actually I heard from a tax presentation given by some tax advisor. So he said, okay, he's a real estate investor, right? So he asked his accountant to try to reduce his tax burden. So then they do that. And then for the past 3 years, they show zero tax, which is a good thing, right? But what's the trouble? Now he wants to invest in another deal. He goes to the bank said, okay, I can lend you the money. Show me the tax return for the past 3 years. He doesn't want to show that because he never paid the tax for the past 3 years. Now the bank refused to lend on the money. So now you see there's a conflict between reduce the tax versus you have the capability to borrow the money to grow your capital. So just be aware of sometimes if you go too far in one goal, you might hurt the other goal. The second goal will be, okay, if I just want to grow capital as much as possible without receiving the cash flow versus, okay, I only generate cash flow and I always take out the cash flow paid by the property and then use somewhere else. You will never grow your capital. So yeah, so every time you receive the cash flow, you need to decide whether I want to put them back to the new deals so that I can grow my capital, or I just take it out and then just enjoy the life. So these two sometimes might have conflicts as well. So what is the solution? So you can think maybe my short-term goal is this, long-term goal is that, and then we can have more than one goal, but maybe with different horizon. And also sometimes you can have a basket of goal, but assign different weights to it, right? So that's a way to try to compromise different goals. Okay, now let's move on to the second component, constraints. So different constraints. First thing I want to point out, very, very important, different people have different investment horizon, and it's much longer than you expected. let me give you a concrete example. Let's say you are 50 years old. You think that your investment horizon is 10 years until you retire. Wrong. Your horizon is actually from 50 to your life expectancy, meaning that, for example, if average American, let's say the life expectancy is, they die at 80. So you have 30 years to live. You have to think about all this living expense until you die, right? So if you incorrectly assume your investment horizon is only 10 years until you retire, then you will actually invest in a less aggressive way because you think, oh, I only need to cover my 10-year expense. So then you run into the risk that the longer that you live, you are short of fund to cover your living expense. On the other hand, if you think your horizon is longer than actually needed to be, you might go to the other extreme. So what I'm trying to say is that first, correctly estimate your investment horizon so that you can determine what is the return and what is the risk that you can accept. So that's first thing you need to decide. Capital constraint, this is simple, right? So how much money you have, how much money besides your expense that you can invest. Risk tolerance, different people have different risk tolerance. Break it down into a capacity, right? So how much capital you have, how much you can afford to lose versus the willingness to take risk. Okay, I might have a lot of capital, but I just don't, I like to be conservative. So I'm not willing to take risk. Those are the two aspects of risk tolerance. Liquidity constraints. Okay, so if you have some, you know that in the short-term future, there's big thing happen in your life. Let's say you get married, right? So you need to buy a ring. Okay, that might be a liquidity constraint there, right? So you need some liquidity. Yeah, all kinds of special things happen in your life: retirement, education, litigation, marriage, kids, bankruptcy, everything that will affect. That will be a constraint to your investment. You have to take that into account and also think about when these events will happen. You have to associate the horizon to those events to make sure that at that time you have enough money to cover those events. Knowledge constraint, right? So there are different as a class out there. You need to understand them before you can invest, right? Okay, so now let's talk about risk. Okay, risk, I have a slide later on talk about there are different type of risk to measure risk. One type, which is constantly used by Wall Street, is volatility. What does that mean? So basically, if you have a lot of data, you calculate the standard deviation, they said that's the volatility, right? So how uncertain your return is, that's the volatility. So they call it risk. So how volatility can erode your returns. So this is a hypothetical example. 10 years, okay, portfolio A, very boring. Every year you receive a constant 8% return. So average return, you do the average, simple average, 8%. Standard deviation, 0. So volatility is 0. Okay, portfolio B, it's like riding roller coaster, right? So sometimes you have huge gains, sometimes you have huge loss, and then at the end, if you take the mean, the standard deviation, the simple mean, it's 9%. Would you say portfolio B is greater than portfolio A? No, not quite. So if you look at the standard deviation, that's 18%. What does that mean? Okay, so now let's look at this. Okay, the starting point, you have $100. Okay, this number means that, okay, after the 1 year, $100 becomes 108. This, because it's 23%, it becomes 123, right? So we do that math at the end of 10 years. This boring portfolio you grow your capital from 100 to 216, but this roller coaster portfolio give you 208. Why? Because this volatility, right? So if we dive into that, let's use this example. The 7th year, you suffer from an 18% loss. What does that entail? Let's put this hypothetical example. At the beginning, you have $100. If you suffer 18%, that means at the end of year 1, you only have 82 left. Let's assume next year you want to catch up to $100. How much annual return for year 2 in order to make up this 18% loss from the previous year? It takes 22%. See that? Because you lose this. So now you have to have much bigger upside in order to compensate the loss here. Let's make it extreme. Let's say now you're back to 100. Year 3, you lost 30%. Now you are at 70. If I want to recover to 100, how much you need? You need the 43% return. Okay, so okay, now go to more extreme case. If you suffer 50%, how does that cost? It takes 100% in order to get back to where you are. So you see, the bigger the standard deviation or the volatility, the worse return you get. That's what we mean by volatility erodes the return. So when you compare different portfolio, you try to achieve higher return, however, subject to control the risk, right? So go back to this. So you try to maximize your return subject to, okay, if I can control my risk, that would be better, okay? So that's one thing. Okay, now we talked about investment goal. We talked about the constraint. Now, the magic part is asset allocation. So what do we mean by asset allocation? First of all, on left-hand side, you have money in different accounts, right? 401k, IRA, cash, checking account, saving account, self-directed IRA, personal trading account, or maybe you have access to other people's money. On the right-hand side, you have different asset class. They're available for you to invest. Stock, bond, corporate bond, real estate, commodity, or just sitting on the sideline, cash, right? So allocation means that how do you match this so that you can achieve your investment goal or lower your tax burden, right? Because although these are the same money, these are the same asset class, different allocation will have different tax impact to you. Okay, so think about that. So, okay, so let's dive into it. Okay, the question you want to ask is that what are the asset class available out there? For each asset class, you want to study the history of it to see what is the risk and reward. So these, for example, you can measure by the volatility we just talked about. These we measure by the return, right? So how does the risk reward profile look like in the history? And will that pattern continue in the future, or you actually can foresee some changes? Okay, so second thing is that, okay, when you look at different asset class, don't look at it as standalone asset class. You need to look at the correlation between different asset class. For example, historically speaking, when equity goes up, the bond market behaves differently. Why? Because this is more conservative. This is more aggressive, right? So imagine you have a capital. It's more like a vote, right? So you think the economy is doing good, you vote by putting more capital into risk-on asset. This is what we call risk-on asset. Okay, the economy is not doing good, you vote by putting more capital into risk-off, like this. It's risk-off asset class. Okay, what are the traditional risk-off asset class? For example, bond, gold, and also gold is a good hedge of inflation if you are worried about inflation risk. Okay, JPY. Okay, those are the traditional like a risk-off asset class. You can pull up their return time series and then see how they track with each other. Oftentimes you will see this goes up, this goes down, right? So by pairing these two, your portfolio will have a smaller volatility, which means you actually reduce the risk of your portfolio. Although you will say, I don't understand, I want to invest in S&P because this one definitely had higher return than bond. Bond's boring, right? So you only get very low return. But the point of having bond in your portfolio is that you can reduce the risk of your whole portfolio so that in the long run, it actually achieve higher return. Okay. Then the next question you will say, okay, how much capital do I have? Are they distributed among different accounts, right? So some accounts are taxable. Some accounts are tax-free, like a 401k. Sorry, 401k is tax deferred. And then some are tax-free, like Roth IRA. So how do I allocate it, right? So imagine you have two deals. One deal can bring huge capital appreciation. To me, I would prefer to have that deal from my tax-free account. So when I cash out, I don't have to pay a huge amount on the capital gain, right? If I have a deal that's generating not much upside, but generating stable cash flow for me, I would put that. I would not put into my 401k or IRA because I cannot take that cash, right? So the reason I want a cash flow deal is because I want to use it. So I will put into my taxable account. So those are the things that you need to consider. Okay, so we talked about three components. So putting them together, you will have what we call IPS. So basically it's an investment policy statement. Don't worry about it. We will have that on the checklist. Okay, so that's a general framework of asset allocation. So now let's look at historical returns of different asset class. So this is just an illustration. We compare 4 different asset class: real estate, bond, stock, cash, saving. And then are these real or hard asset? Whether it's generating the high cash yield, what is the leverage? This one I want to point it out. This is very interesting because a lot of people, when they look at the stock return versus the real estate return, they will say, real estate return actually is slightly lower than S&P. So why should I invest in real estate, at least as part of my portfolio? My answer to that, at least from my personal view, is that, okay, real estate offers something that stock does not offer. What is that? First, the leverage. Have you ever used 20% and then buy 100% of stock? No. If a stock costs 100, you pay 100. But with real estate, you can use the leverage, which means you will enlarge your return. That's one thing. Second thing I would like to point out is that tax treatment are different, right? So especially after Trump become president, you actually can gain a lot of tax benefit in real estate, which cannot be done in stock. So those are the two things. So when you look at the return, just don't look at the face value. You have to factor in these two things when you do the comparison. So those are the things I want to point out. Now
we have a quick question, Yan. So
okay.
A question from my audience, Seiko. So in the current climate, would you suggest investing real estate in tax-deferred account?
Well, again, depends on your needs first, right? So you want your real estate investment to do what? Is it capital appreciation or cash flow? If you want to generate cash flow, you put into your tax deferred account, you can put into, if you are aiming for capital appreciation, yes, you can put into tax deferred account, but you have to do it in self-directed IRA, because 401k, you cannot go to your broker say, I want to invest in real estate. They don't allow you to do. So do some research on self-directed IRA. Yeah, there's other means that you can invest. So
Yeah,
you basically take control of what you can invest. Yeah.
that's a good answer. And I think maybe the question is asking kind of what the current climate is. Maybe that's what the emphasis is. And we're going to talk about that a little bit in the later part of this series, like what is going on with the current economy and what should we do. So we'll keep that question open.
Right.
Okay. Yep.
Yep.
All right.
Right.
Good.
Okay. So these are actually the historical winner and loser among different asset class, right? So don't worry about that. It feels so dizzy. What you want to learn from this chart, one takeaway is that there's no a long-time winner, or there's no long-time loser. Every year the color changes, right? So what does that mean? That means you always need to have a diversified portfolio, because if you just owning one thing, every year you will have different outcome. So you want to pick several things so that overall your portfolio is doing great, right? So that's one thing. Okay, these two I already talked about. You need to think about the tax impact, but you think about the return, and then also take into account leverage. Risk, I mentioned the volatility as one measure of risk. Another very straightforward measure is that, what if I lose my principal? That's a risk, right? So that you need to think about it. Okay, what is the opportunity cost? Meaning that, okay, with that capital, you can invest it in asset class A or B, right? So you decided to go with A. It turns out that class A give you 5%, but class B give you 10%. Okay, it looks like you are making money. However, the opportunity cost is that you give up the opportunity to make 10%. So these are the things that's the risk, right? So different measure. And then you also need to think about liquidity. Obviously, for example, real estate, by definition, the liquidity will be lower compared to other asset class. That's why when you think about your liquidity needs, you need to have a portfolio that can offer that, especially around your special events in your life, and then text, right? So don't worry, this link, you can look at all this data. Hopefully you can see it there, but this chart makes me feel very, very dizzy.
And it looks like not every the winners is not always the winner. It's I think one of the key point you can see here. It kind of shuffles a little bit. That's why maybe it becomes important to kind of diversify.
Exactly, because it's very hard to time the market. A lot of finance professionals want to do that. There's not a lot of people succeeded in doing that. So yeah, as normal people, I would suggest, okay, just have a basket. Make sure overall you are doing okay. Okay, now let's zoom in a little bit. What happened to 2019 and 2020 YTD? So you do see they behave differently, right? So this is a month by month. What I like about this chart is that it shows you the volatility, right? So it's not just the starting point and beginning point. You also see the path, right? So is it volatile or is it stable? Okay, what we can learn from this chart, I think this is the blue line. What is this one? Okay, US real estate. Looks like these 2 years are pretty good for real estate. What is this one? This is stock. Yeah, it's also doing great.
Thanks to Donald Trump.
Okay, yeah, and then, but of course, 19 and 2020, they paint different pictures, right? So this year, because a lot of things happen, so you see on this side, a lot of actually, for example, gold, as I mentioned, this is a risk-off asset. So it hedge, right? So actually this year is making a lot of money. By the way, this is only to May. if you look at today, probably the picture will change. We never know, right? So, and then here, 10-year treasury. Yes, this is the risk off asset class, right? So it doesn't, it's not surprise. Okay, NASDAQ, I think this is driven by Fed, right? So on this side, we see, okay, commodity are losing a lot. At one point, you remember that there's oil, like a negative price. So you have to pay somebody in order to give the oil away. So yeah, real estate is not doing great. We lost 15% up to May. So yeah, stock market is losing a little bit. But now if you look at it, it's probably positive. Okay. Okay, so now let's zoom in to see inside commercial real estate, what are the performance of different asset class. Okay, when we look at the performance, I need to break it down. Okay, how do we compare different asset class? What are the relevant metrics? Where do I find the data? And then what is the right way to look at data? Don't just take the face value, right? So, okay, commercial real estate. So for those who are more familiar with residential, meaning that single family house or maybe small multi-unit like 4-family below, those are considered to be residential. Commercial is actually anything bigger than that. For example, apartment building would be a commercial, and others like an office, warehouse, whatever, right? So those are the, or retail, those are commercial. So it is different from residential in several ways. For example, one thing I can think of is that, okay, first of all, from the lending perspective, then the bank will definitely have different lending standard for commercial versus residential. Second thing, if you invest in single family house, the biggest loss is that, okay, if you cannot find a tenant, it's vacant. It's 100% vacant. But if you own apartment building, if one tenant left, you still probably have 90% occupied, right? So, which means you have less loss, because when you have those vacancy, you still need to pay the bank, you still need to pay the tax, you still need to pay the insurance. So very important to keep the vacancy rate low. So apartment building compared to single family has lower vacancy rate. We can see that later on. Another difference is that the valuation of residential versus commercial is different, right? So when you buy your primary home, how does they evaluate? Basically, they look at some comparable in your neighborhood. Oh, your neighbor just buy this house at this price. They look similar to yours. So, okay, they will use that price to evaluate the price, the value of your house, right? So that's do by comparables. The commercial, on the other hand, actually is evaluated using this formula. NOI means net operating income, meaning that, okay, let's use apartment building as an example. You collect the rents from your tenants, and then you pay all this expense, right? So you are left with net operating income. Okay, annualize the net operating income. Then you divide it by cap rate, so capitalized rates. So basically, after you divided that, you basically can sell at this price. So this is good compared to residential because you fully control this part. This part may not, because yeah, the asset class, the market you are in, basically it's converged, right? So you don't have full control on here, but you do have control here. So, okay, so now let's look at it. So what I want to see is that by looking at, so first of all, it's very hard to get the data for real estate because there's no liquid market to trade it. However, we can find a proxy from REITs, right? So, but when you look at REITs, I think a lot of people, they look at it in the wrong way. So they just look at the REITs, it's traded like stock, right? So they look at the return. and then compare to S&P. That's it. No, that's not the right way, because the day-to-day price, it does not reflect the underlying operation of the real estate. It's just the supply and demand on the stock market. Although they might not diverge too much, but I don't want to take the face value of it. I want to look at the data underlying to see what's the underlying business there. So what the measure that I'm looking for is NOI, right? So if you look at the financial statement of those REITs, you found the NOI. And then when you look at this chart, you're not looking at this because that's the aggregated NOI. I want to do the apple to apple comparison. So that's what we call the same store NOI. Basically that give you apple to apple comparison, right? So now let's dive into it. So these are the different asset class, office, industrial, retail, residential. Residential is the one that we just mentioned, self-storage, and then the black is everything, right? So the first thing I notice here is that, okay, we see the yellow line stands out. What's the yellow line? Okay, yellow line is self-storage. Why it stands out? It looks more volatile to me. So meaning that the standard deviation is higher. It might not be a bad thing. Some people just like because they have higher risk tolerance than other people. It really depends on your situation, but this is a fact. This looks more volatile. You also need to understand why. It's possible that because this sector compared to other sector is more fragmented, right? So a lot of competition going on, that may be why you will see this volatility. I don't know for sure, but that's one possibility. Okay, the second thing we notice is this gray line. It's the opposite of the yellow line. So this looks very stable compared to other lines. So least volatility, right? So that's the retail. Okay, that's interesting. That's good. However, I also noticed since maybe this 2014, you see this downward trend. It persists this way. Okay, meaning that, okay, I guess the reason behind that is, okay, the retail is facing a lot of competition from online shopping like Amazon, right? So that's why the growth actually slows down. If we extend it to COVID-19, this probably will continue this trend. Okay, what else can we see? We also see residential here, the green line. It recovered very, very quickly since 2009. It recovered faster than everything else. So that's one observation. And then another final observation is that, okay, the red line here, industrial, had highest NOI growth since 2016. Okay, where we are, the red line, okay, here. Yeah, that also matched with our observation, right? So because of this booming of online shopping, you need the warehouse to hold a lot of inventory. And thanks for last mile delivery, actually industrial is very hot in the past several years. So that's what we can observe. And then we probably can guess what's the reason behind that. Okay, now let's zoom into residential and further break it down into apartment, single family, and manufactured home. So those are the mobile homes, right? So one thing I want to point out is that because this is based on REITs, right? So I guess that those REITs, a lot of them are actually apartment REITs. That's why you see these two lines, basically they overlap with each other because this is weighted average, right? So if you have more apartments than other stuff, these two lines overlap. Okay, what we observe. The green line, again, is less volatile than any other stuff. Okay, which is good, right? So I guess that's also why Buffett, he actually owns a huge company that produce this manufactured homes. If you are interested in it, you might want to dive into it. Okay.
And it also has never gone below zero in the
Yeah.
NOI.
Yeah, so
Very
if
stay
you are
defensive
right,
asset class.
exactly. If you're looking at like a crisis resistant as a class, this might be worth considering. That's very good observation. Thanks for pointing that out. I didn't notice that one. Okay, so oh, actually I do notice. Okay, another thing is that okay, single family here we don't have enough like history, but looks like it's more volatile than other stuff. But I also want to point out that this is highly dependent on the location, right? So this is just national average. So don't read too much into it. We need to dive into a specific market before you reach the conclusion. Right? So, okay. Now let's look at the retail. Okay, retail can be further broken down into shopping center and regional malls, right? So shopping center, the bigger one. Regional mall, maybe like a strip mall type of thing, right? So we observe this purple, okay, shopping center. You do see from the year-over-year growth, it's actually worse and also more volatile compared to regional malls. That also match with other research report that we read. So nowadays, people don't want to go to a huge shopping mall. They prefer to go to a strip mall, which has some like a anchor store, like for example, Whole Foods, and also surrounded by some experience type of store, like a hair salon or doing your nails or whatever, right? So those type of, or gym, right? So those are more popular nowadays. But COVID might change again because you cannot go to those experience type of like a store during COVID-19. So yeah, it constantly changes. You have to look at the data, understand what's behind the data. Okay, so now those are the NOI, right? But NOI is just the final result. What affects the NOI? So as we said, this is your rent subtract your expense. So what affect your rent income? Occupancy, rent growth definitely affects your income. Expense is another item will affect your NOI. So now let's dive into it. So occupancy, what do we observe? Of course, the first line I see is that, what is the purple line? Purple line is apartment. Okay, apartment has the highest occupancy from 2003, like almost 17 years, right? And it's very, very stable. It's roughly stay around 95-ish, right? So that's the first thing I noticed. The occupancy overall is actually improving after 2010, more or less. Okay, the next point will be industrial occupancy improved a lot between here and 2017, right? So that's this light blue. So you see here, the slope is very high. Okay, office has lowest occupancy, and if you extrapolate out, you might see it go down due to COVID-19, but not immediately reflected because they have a long-term contract, right? So we will see. But overall, yeah, if you have a 95%, that's very good number. So you see that the cap is at basically 95%.
Yeah, I think what's interesting to me is that during those years where we had a recession, you see that the office and industrial, they all came down really bad. Retail was relatively okay, but apartment did quite well in this regard. So,
right. I think it makes sense, right? So even though there's a crisis, people still need to find a place to live, right? So overall, that makes sense. It's just which market you choose to invest in, then the occupancy for that market will be different from a different market, right? So yeah, so carefully choose your market. Okay, now let's look at the rent growth. I really like this chart. It tells you, okay, different sectors. Here we have multifamily, industrial, and office. how do they behave in the past two recession? This one is 2001 recession. That's the tech bubble. This is in 08 and 09 recession. That's the financial crisis, right? So this number tells you, okay, the light blue is how long it continued to have negative rent growth, right? So those are the month, right? So the longer, the worse, right? The green one is how long it takes for this sector to grow from the bottom to the pre-crisis level, pre-peak. Okay, the shorter the better, right? So it covers faster. And then this dark green is grows past prior peak to next downturn. Okay, how long it continues to grow before it hit another downturn, right? So it's very interesting. And we see that, okay, during the same crisis, the tech bubble, multifamily, which is another name for apartment building, it actually has very short negative growth, and it recover very, very fast, and it continue to grow. These two, they take about a year going downward, and then industrial recover faster than office. And then it continued to grow, but very, very short. Okay, 08 and 09, it had a different picture than the previous crisis, of course, because the cause of the crisis are different, right? So what do we see here? Multifamily, okay, so negative growth, it's a 5 or 6 month negative growth, then it quickly recovers. See, this number is the same, 7 months to recover. And then it continued to grow 29 months, so more than 2 years before it hit the downturn. Industrial, longer downward and longer to recover, and shorter, like it continue to grow, right? So you do see these three more or less are the same. It takes very long, almost 2 years to recover. However, multifamily is very resilient, I would say. It took a hit, but then it covered quickly. So that's what I want you to be aware of. Not all the sectors are created equally. And then also when you try to underwrite, if you are doing any deal right now in COVID-19, you don't know what the future will look like, underwrite conservatively. Budget in negative rent growth or flat rent growth. Because I know that before COVID-19, everybody want to budget like a 2%, 3% rent growth every year. That's hard to imagine after COVID-19. So underwrite conservatively. Okay, now move on to the denominator. Remember that we talked about it's NOI divided by cap rate, right? So now let's compare the cap rate for different asset class. Right, so what affect the cap rate? So overall, it will be affected by the Fed interest rate, right? Then it's a function of supply and demand and the risk. So let's look at it. Okay, you see this is a downward trend, and I can guarantee it will continue to go downward from here. The reason, let's look at this. Put this into perspective. This is maybe 30, 40 years interest rate history, the 15-year, 30-year mortgage rate. So now we are here. Look at it. This is the lowest in the history, and it will continue, right? So if this is the current interest rate environment, you can see the cap rate will continue to be low, right? But of course, when you compare different asset class, you will see the first thing stands out is the green one. Green one is, let's see, lodging. Okay, hotel. Okay, there's a reason why this is high, right? Because it took the hit right now, for example, right? So cap rate is higher, meaning that the price is lower, right? So imagine right now you don't want to buy a hotel,
Or you have to get a lot more return to compensate for the risk that you take.
Exactly.
Yeah.
Exactly.
So this has an inverse relationship with the price. So
Exactly. Right. So this gap is risk. And thanks for pointing that out. That's a very good point. Right. So that's the first thing to notice. But if you do have the capability to turn around hotel, you can take advantage of it by buying at a very high cap rate. And then when you sell it at a lower cap rate, which means you sell at a higher price. Right. So, okay. So lodging, we do notice that. And then industrial, industrial is the light blue. You see here, it's the lowest among all these sectors since 2006. That's what we said, okay, it is the darling of the market for the past few years. Okay, so now it's at 4 or 5. Do you think it will continue to go down, or so it depends on your judgment, right? So do you want to pay that because you think it will continue? Yeah, everybody may have different opinion. Or
I
you
think that would be subject for a great debate
yeah,
because we saw
exactly.
from the last couple of chart, industrial has the longest time to recover from a recession. It'll be interesting what this one would be, whether the Amazon can reverse the curve.
Exactly, exactly. So yes, so one thing I do want to point out is that when you look at the data, right, so you need to take into account, we are looking at historical data. Whether the future actually will repeat the history, that's a question mark, right? So that you need to pay attention to, is there any like an emerging trend beneath it? Or you think, no, there's nothing. So we believe it will continue to behave the same way in the past. Yeah, so you need to bear that in mind. Okay. Okay, now we also talk about supply and demand. This is the supply, right? So you look at it historically. Okay, we do notice office in the past several years, it actually, the supply increased a lot. That might also explain why the occupancy rate is low. We also see here during the past several years, industrial also increased. Residential actually reduced a little bit here. Those are the noticeable trend that we can see from this chart. Okay. Okay, this is just a summary. Don't worry about the when you receive the deck, you can actually read it. So right.
Yeah, maybe just do a quick process check. I think we are approaching the hour, so I
Oh,
know
okay.
we actually still have quite a lot of contents to cover.
Right.
Yeah, there's a couple key questions that we'll be asking, or what do we think is whether it's safe to include real estate investment in a portfolio now? I think that goes back to one of our audience question earlier, and how we might actually, are we going to see distressed asset, and or should we buy them now, or would there be more discount later? I think there's a lot of good things, but that's probably going to be, I would say, probably quite lengthy discussion and a lot more charts to share. So
Right.
maybe it's a good place to, I would guess, take some questions, and maybe we would do a second part of it. Plus, we would talk about some of the post-COVID trends, because I think there are a few that are emerging.
Right. Yeah, yeah, I do agree. Actually, those are the questions a lot of people are thinking about. It's up to the audience whether they want to actually want to finish, which means that would be much longer than I thought. Sorry about that. I'm not doing a great job at
No,
controlling
no, this
time.
is great content. I think I don't want to miss any part of it. So I
Uh-huh.
guess maybe if you the audiences, if you would like to
Yeah.
just give us an upvote, should we keep going? Probably take
Or
another 15, 30 minutes, or
right. Or maybe what we want to do a different section. I'm open to either of it. Depends on the audience.
yeah.
So maybe you can actually type
We
in.
have one vote. Let's type in a Zoom. Also,
Mhm,
if you have any questions, feel free to add right now.
mhm.
Okay. I think so far we have a couple of yes, keep going. Cindy, let's continue. Lady, I can't stay on. So
Okay. Okay.
oh, and we have a hand raised. Let's get to the question real quick.
Mhm.
Where is the hand raise? I'm still navigating. Oh no, I think that hand was just put down. Never mind. Oh wait, no, I see it and it's gone. I think that was a question. I was in the
I think it's
Q&A.
in Q&A, right? Is that?
Oh, okay. I think Mary said keep
Okay.
going. All right. Okay, let's do it.
Okay. Looks like a lot of people have curiosity. Yeah, I have the same thing. So those are the questions that I actually ask myself, right? So uh, because I am ordinary investors, just like you, right? So I also feel scared in current environment because there's a lot of uncertainty. I probably consider more than you because I'm a risk manager by trade. So those are the questions I ask myself, right? So, okay, let's continue. But we do try to speed up a little bit. Okay, let me show you this cool chart. Okay, what the future will look like. No. Okay, hold on just a second. Okay, I found this cool chart this afternoon. It's really cool. It's called What's at Risk, 18-month view of post-COVID world. So it basically lists out all those risks and break it down into economic, social, geopolitical, tech, environmental, right? And then it's ranked based on the possibility. So this is higher, this is lower, right? So, okay, let's go over some top risk that they think, right? So prolonged recession, bankruptcy, and consolidation, and then fail to recover, industry fail to recover, high unemployment rate. And look at this, 50%, okay? Okay, restricted travel, which means if this is true, that means, okay, we'll have a huge impact on airline and hotel. Okay, weakening major economy, so on and so forth, right? So this is really cool. Then lay out a lot of uncertainty.
The
So,
wheel
okay,
of misfortune.
yep. And then now let's go back to our investment world. So now, how do we consider all those things when we make a decision? So first thing I ask myself is it safe to invest now? Right? So, okay, how do I address that question? So first thing I look at it is that, okay, is there any similarity between now and '08? Is there a repeat of '08? Okay, so if we look at '08, we want to know what caused the financial crisis in '08. What about this time? Are they driven by the same factors? We will do some reality check there. And then when we look closer, we will zoom in. What are the things that cause failure, right? So how can your investment go south? Okay, over leverage, definitely. Okay, mismanagement. For example, if you invested in an apartment building, right? So the property manager doesn't do a good job, or your operator had no experience in crisis. They don't know how to rent out the units. So there's a lot of vacancy, right? So mismanagement, oversupply. So for example, office, there's oversupply. You happen to invest in office, okay, then probably you have high vacancy rate, right? Okay, demographic trend. If you do not realize this trend, you probably your investment probably facing the headwind instead of the tailwind, right? So what is important in demographic change? We see that millennia actually passed their peak. What we observe is the baby boom right now is reaching their peak, right? So I forgot the number. Every day there are how many people turn into 75? imagine that trend. If you invest in the sector that can take care of that needs, you have huge tailwind. Okay, another reason that your investment can go south is because you are chasing the hot asset class, so you overpay when purchased. Those are the things that could cause the failure, right? So let's zoom in. Okay, is it safe? My conclusion is that OA is caused by over leverage in housing market, right? And this time it's different. The measure that I look at is what is the debt over total asset. You will see this is OA. This is right now. It's like 65 to 35. It's like a half, right? So I would, okay, there are other measures. Let me show all of them. Okay, what is the weighted average interest rate? Obviously, the higher, you have more burden to pay the interest, right? If it's lower, your monthly payment will be lower. Okay, so it's the lowest compared to a historical level. Okay, what about interest cover ratio? That means your EBIT, earning before interest and tax, divided by your interest expense. Okay, I have highest coverage. What that means is that with the earning before interest and tax, I have more money left to pay my interest. Okay, another way to look at it, if you look at your interest expense divided by NOI, it's the lowest. So with all this data, they all give me the same story. This is not the repeat of OA, because this time the crisis is driven by something else. And real estate as a sector, overall, I think it's pretty healthy. Overall, it's not over leveraging. Okay, so that's the conclusion. So the conclusion to the first question is that I think real estate are safe compared to OA. So that's my conclusion. Second question is that, okay, people will think, okay, Warren Buffett said, so be greedy when other people are fearful, or be fearful when other people are greedy. Okay, let me be contrarian. Why should I invest now instead of, okay, waiting for like a lot of bargaining on the street, right? So then I can buy 50 cents on the dollar, right? So, okay, so I hold on to my money and then wait for that. Do you think that will happen? That's another question that I ask myself. What is the right time to jump into it if you decided to jump into it? So what I look at it is that, okay, so this is from the Yardi report. It just came out probably last week. It's called Distress Assets Outlook Beyond this Financial Crisis or whatever, health crisis. Basically what they're saying is 3 points. It's very hard to read the paper. It's very like a technical. However, I think there are 3 main takeaway is that, okay, there's not a lot of distressed assets available there. Limited supply. Why? Because first of all, we already said it's more healthy than before. Second, because Fed keep injecting money into this sector, those asset class will survive longer. So right now, there's not a lot of distressed assets available there. Second thing, okay, can I buy it very cheap? We just said, because the rates are very low, cap rate will continue to be low, which means the price will be high, okay? So by waiting longer, I don't think that the cap rate will all of a sudden spike up, which means you can buy at very low price. I think that scenario will be very unlikely. Third thing, okay, let's think about the demand side. Okay, do you know how much capital sitting sideline just to wait for the opportunity to jump in to buy distressed asset class? 5 trillion. do you think you can compete with those money? Those are all institutional funds, like money market fund, because they don't have a lot of the asset class to invest that can generate high yield. So they are waiting for the opportunity to buy distressed asset class to jump in. I don't think I can compete with those money, right? So, okay, now if you really want to play, what is the strategy? You probably want to jump in a little bit earlier than them, right? So don't buy at the dip, right? So instead, you can jump in a little bit earlier, and then you can invest in the deal with solid cash flow instead of just buy really, really cheap asset class. That might be a strategy you want to consider. Okay, if we do find the distressed assets, where are they located? Most likely in hotel and then retail. Look at this. This is April. This is May. This is June. 30-day delinquency. You see multifamily, office, industrial, they're doing fine. Not a lot of delinquency, right? And I don't see a huge spike up month over month, right? The past 3 months. But you do see hotel and retail are dramatically impacted by COVID-19, reflecting in May and in June, right? So if you really want to get into it and you have the stomach to invest in these two sectors, then the strategy you can play, you might want to consider, is adaptive reuse, right? So you buy this and then you convert into something else, right? So that may be another strategy you can think of. Or you have the management experience in hotel or retail, feel free to jump in. Okay, so that answers my question. Should I wait to buy the distressed asset class? To me, I would think I can compete with those institutional money. They are already waiting there. I don't think I can find any opportunities there. So the third question is that, okay, I assess all the risk. I decided that now is a good opportunity to buy, for example. Now, what should I buy? Okay, how about equity market? The equity market is doing great, right? Ridiculously great. So should I invest there? Is there any bubble there? Okay, what do we learn from history? We already covered that. We show you 20-year history of different asset class, even zoom in to different sector in real estate. We already covered that. Okay, so we also covered this. Are there any sector that's more crisis resistant? So now I want to make this point. Should I invest in real estate, in equity? Okay, what I see is that the real economy, I see jobless claim is very, very high, meaning that real economy is not doing great. And in the corporate world, we see higher and higher leverage, right? So this, this is the bond. This is the debt to GDP ratio. It takes a higher and higher leverage, which means you are probably later on, you will get busted. The probability of getting busted is higher and higher, okay? Where we are when we look at the PE ratio. So this is in extreme bubble. So this, and then this is stocks are in the bubble where we are here, right? So it's in the middle of this bubble zone, just shy away from this extreme bubble. So I present all the data. You can make up your mind whether you want to invest in the stock market. And also depends on how long is your investment horizon. If it's really short, there might be some uncertainty. But if it's long, you probably don't care. You put into your 401k. 5 years later, you look at it, boom, it grows a lot, right? So yeah. So carefully choose the asset class and then have a portfolio And then as a result, you can achieve your goal and then also reduce the risk.
We have a quick question, Yan, from the
Mhm.
audience. Question
Okay.
is from Lee Du. Is it possible that the office has delayed it drop? Do you think that
Yes.
office is going to fall?
Yes, I actually, this is my assessment as well. Remember, when they signed the list, they signed long-term contract, right? So we are only like 3 months, 4 months into this like a quarantine thing, right? So it will not be reflected in current contract. Although I think that probably some companies, they already like started renegotiating the terms, but I don't think like a 3 months data points will pick up that change. So that's a good question. That's also my guess as well.
Right. I think also when people are maybe get to work from home and
Mm-hmm.
corporations find out that they can still be relatively productive, maybe they are
Yep.
getting rid of the office. I think Twitter actually might have let
Yeah.
everyone work from home permanently,
Yes,
right?
yes, we saw that news, I think today, right? So yeah, a lot of tech companies, especially, they actually announce if it's not like work from home till the end of this year or next year, some company even say you can work from home forever, right? So another trend we see, okay, it's actually related to this, right? So we talked about the history, but future is not necessarily the repeat of history, right? So we also need to pay attention to the emerging trends, but we need to make a judgment call. Is it just temporary, or do you think that will be like going forward, it will be a new trend, right? So office is a good example, right? So do you think remote working from home is like a permanent trend? So if it is a permanent trend, that means, okay, people are fleeing out from those high housing price area, like California, to more affordable, like Sunbelt states, right? So you can live bigger house, less dense population, and you get to the nature, right? So those could be a thing, right? So I hear a lot of people talk about flitting from high density area to low density. And then even in the same city, people would say flitting from downtown to suburban. Also, I heard some people talk about, oh, because of this working from home thing, so when you have new development in apartment, they will think about building more dense and maybe smaller common space. And then recently, probably you will see rising supply cost, but maybe this is a temporary thing, we don't know. But let's look at the migration. This is a very interesting topic. Let's look at some data. So this is from Redfin, but bear in mind, Redfin, probably it's mainly on single family. Do they have apartment? I think they probably have apartment data as well. Okay, so this is the level of the search that people are looking to move. You see, so this is from 19 to 2020, it coming up, right? So we will say more people want to move. It's not like it started by COVID, but COVID definitely accelerated the trend. Okay, so now we're really interested into like where do they move from? Where do they move to, right? Okay, so this you probably cannot see, so I will go to this one and then we will see from here. Okay, let's see. All right, how do I make this bigger? Would that be bigger? Can you guys read it?
I mean, just one more, I think you can see pretty well. Okay, yep.
Yeah, okay. So, okay. These are the outflow states. These top 10. Okay, let me read it out. New York, San Francisco, Los Angeles, Washington, D.C., Chicago, Seattle, Denver, Boston. This one I'm not familiar with. These two I'm not familiar with. Okay, so where do they move to? Okay, so this column is the, so people from this metro, their top destination is this. And then this one is top out of state destination. right? So this is nationwide. This is just out of state. So let's look at it. Atlanta, Sacramento, San Diego. This one I'm not familiar. Phoenix, Los Angeles, Seattle, Portland. Okay, that's interesting. And then what is the median home price from this state where people flees from, right? So you see, well, 520, this is 1.5 million. Well, you get the idea, right? So I would say probably 500, 600, roughly. Okay, now let's see where they flee to. Okay, Phoenix, Sacramento, and then Los Angeles, Atlanta, Austin. Okay, cool. We have 2 Texas market, 2 Florida, and then Nashville, Charlotte. Okay, those are not the names that surprise me. Yeah, those are very hot market, right? So let's look at the average medium house price. Okay, 300, 400-ish. Yeah, you see people, why people are moving, right? So if my company allow me to work remotely, why don't I just like leave New York and then go to these places, right? So I can enjoy my life better and paying less, right? So this is a big change, right? So you definitely need to understand the migration if you want to invest in multifamily. So, okay, that's one of the things that I mentioned, right? So when you look at the historical data, don't just stop there because you need to pay attention to these changes. Okay, and second thing I want to point out that the COVID-19 is very new thing, right? So if we are looking at month-to-month data, you only have 3-4 data points. So don't over extrapolate the data. You don't have enough data, right? So don't read too much into it. It might flip month from month, right? So also one thing I want to highlight is leading indicator versus lagging indicator, right? So lagging indicator is more like you're driving through your rear mirror, right? So instead you should look forward, right? So give you an example. What is the lagging indicator? For example, if you want to invest in apartment building by looking at the past 12 months rent growth, yeah, it can give you some hint, right? So, but in COVID-19, when everything is different, reading the past rent growth might not help you that much. Instead, you should looking at leading indicator. What does that mean? For example, you look at some indicator for the activities, like how many people register for a virtual showing, right? So if you can read that, that's a good sign because more people viewing your unit, vacant unit virtually, that leads to more like interest, which might lead to lower occupancy, right? So those are the example. What is the leading indicator? What is the lagging indicator? Don't project based on lagging indicator, especially when there's uncertainty around. So future might not look like the history. Okay. The third point I want to make is that, okay, let's suppose you cannot find enough data. So there's a gap. So use common sense, understand the drivers behind those data and then make your judgment call. And also open to different opinions, listen to debates, and then take what makes sense to you, right? The last point I want to make is also a reminder to myself. Don't analyze the data just by doing that. Sometimes when there's not enough data, you need to take a leap of faith. So if I paraphrase this is what we know. This is the uncertain future that we try to predict. We already know 70% of the data, but we are missing the 30%. What can you do? Well, option one is sitting there, do nothing. Second thing is, I already know 70%. I'm relatively confident with my judgment. So now I just jump. Hopefully you landed here. You might ended up here, but it is the choice that you can make. So with that said, okay, the last question. Okay. So let's say I decided to invest. How would I analyze the deal differently right now versus before COVID? So I reversed the order. So previously, when I underwrite the deals, I first look at the data. What is the job growth, unemployment rate, GDP growth, sectors, the population growth, what are the different employment sectors, right? So those are the things I focus on, market. Then I look at the deal. Okay, what is the NOI? What is the cash on cash return? What is the IRR? Whatever, right? So I look at the deals. Then the last thing I check is operators. Now I actually reverse it. The reason is because when the market is good, like the past few years for apartments, even though you are a new operator or you are a mediocre operator, if you do your market research good, or you actually just happen to capture the population or demographic trend, you probably have good return, even though you are not good at operation, right? It's possible. But now, since everything is different, it relies a lot, at least from my perspective, I would think, okay, I will put more weight on the operator due diligence. So I will evaluate how sound is their strategy. Are you doing value add, or are you doing new construction? Okay, how do you execute your business plan, right? So do you have a system in place? Do you have a process? Do you have enough tool to execute? Do you have an excellent team to execute? Okay, experience. Okay, have you survived last downturn? Okay, if you get burned in OA, you probably learn a few lessons versus someone just new, had 2-year experience, that might be different, right? So, okay, are you focused in the area that you focus? For some people, right now industrial is really hot. I used to do multifamily, now let's jump into the hot market, right? So if you're not focused, you're probably set up for failure. Integrity, right? So a lot of things they don't tell you, or they misrepresent the information. They give you the data, but just tell you the partial story. I don't think that's like a integrity, right? So, and also when things don't go well, how frequent they communicate with you, right? So those are the things that I think, to me, the things that I want to evaluate for an operator. If the operator passed all these things, he probably already taken care of this market and the deal. Of course, it doesn't mean that you don't need to do your own analysis. You do, but he actually also evaluate this too as well. So that's the difference between before COVID and after COVID. Okay, hopefully you can find an operator with excellent execution, management, and communication style. Okay, the last thing I want to say is diversify, diversify, diversify. Diversify on different dimensions across different asset class, because we mentioned there's no one single asset class that's a constant winner or constant loser. They all come in different market cycles, right? So you try to put up a portfolio so that in long run, you are doing okay. Diversify across different regions, diversify across different operators, and then don't put too much money into one deal. You just investing in different deals. Maybe they have different strategies. Hopefully you can have a solid return. All right, so we cover a lot of things. I hope you get the main idea. I want you to have a framework when you analyze your own situation. You can do it step by step. So I create this checklist. So basically those are the extra of what we covered today. and then alongside with the historical data, so you don't have to go somewhere else to download. So if you can email me this and then title step-by-step checklist for asset allocation, I will get back to you. So hopefully that will make your life a little bit easier, and then happy investing. So those are the contact information. If you want to reach out to us, definitely keep an eye on this Coast-to-Coast Facebook group, because we have a lot of free education contents. We're not selling everything. Everything we talk about are the things that we care about ourselves. We just want to share with you. With that, okay, I think Henry, you already covered this, right?
Yep, yeah, we definitely have a couple more events coming planned in August. So stay tuned for more information. Go to the Facebook page. If you go back one slide, go to that link below the Coast-to-Coast Facebook group and sign up. And we regularly share updates, CoStar information, real estate news, all sort of good stuff. So just join in, and we'll announce the next event there.
Right. Personally, I would like to do something similar to this, but on a different dimension. So here we talk about how do you compare different asset class. Another questions I also want to do it on my own is that how do I compare, for example, if I'm interested in apartment building, right? So how do I compare different markets? Like, for example, Texas versus Tennessee, right? So how do I pick the markets? I also want to do that just out of my own curiosity. So if you are interested, definitely stay tuned. Might come out maybe in a month or two, right?
Yep.
Yep. All right. So yeah. So definitely interesting to hear what is your view on the emerging trends, and then yeah, we welcome everybody to express your view.
I think that might be a really good place to stop. But yeah, if you have anything you want to share, feel free to do so. If not, we'll chat pretty soon. Hopefully at the next event.
Yep. All right. So this is a really long presentation, and hopefully people can get what they want.
Yep, great. Well, Yan, thank you for the presentation. This is awesome. Lots of information. Yep, definitely. Yep. So we'll see everyone pretty soon. Take care, everyone.
All right. Have a good night.
Good night. Thank you.
Thank you. Bye.
Bye.